Welcome back to Market Movers, the opening bell. The AI trade might soon take on a whole new meaning. AI-enhanced investing is on the rise and providing people with AI research and insights. Now, the tech is able to cut through the noise and also ignore social media. AI also looks for hidden connections between factors like how sentiment, timing, and volatility combine to create opportunity. ETFs that track the major averages have also traditionally been viewed as safe form of investments. And funds that utilize AI for stock picks might gain that reputation in the future. Well, joining me to weigh in is David Wright, Head of Quantitative Investments for Pictet Asset Management. David, great to have you here. Thank you so much for joining us. So first, can you take us through AI-enhanced investing and what it means for investors?
Great. Well, thank you very much for having me. So what is AI-enhanced investing? It's the next generation of quantitative investing. So rather than a portfolio manager defining a set of factors like momentum or value, and then building them into a model that they use to pick stocks, we take a much wider group of signals or features about companies, maybe hundreds of features, and we train a model using machine learning, a type of AI, to learn from historical data to understand the non-obvious relationships between those features or signals that allow us to more accurately forecast relative stock returns.
And David, I do want to hear about the recent launch of Pictet's first US ETFs, including PQNT. So tell us about the global exposure this brings to US investors.
Yeah, we're really excited about the launch of Pequon and also two sister funds run by our thematics business as well. But Pequon, Pictet's AI-enhanced international equity fund, takes that AI engine that I described that we've used successfully in other vehicles for a number of years, outperforming broad equity markets, and it brings that approach to the active ETF market in the US. It does it in a cost-efficient way, in an enhanced index strategy, offering the best of passive and active. Passive like risk characteristics that look a lot like the underlying index, but then the ability to deliver compounding outperformance over and above the international equity index.
And David, I do want to ask you about hidden stock trends. So first, tell us about what this is and how does AI-enhanced investing actually find these hidden stock trends?
Well, simply, it learns them from the data. Now, one of the challenges with historical quantitative strategies is while that you could develop many different ways of understanding and forecasting what would lead to outperformance of stock returns, maybe something like momentum or a trend where stocks continue on their recent performance, or maybe valuation where stocks that have performed poorly recently or are lowly valued versus their intrinsic assets will outperform over time. But the challenge with some of those simple quantitative strategies is that they don't have an awareness of each other. By analyzing data, by training a model that learns from historical data, it can learn the true relationship between hundreds of different features or factors, and from that, capture the way that these different elements condition each other. So not whether a stock is a momentum stock or a value stock, but if it's a momentum stock and also has another characteristic and another characteristic, is that a potential investment signal? And it's only by learning from data that we can truly understand those non-obvious relationships.
And finally, David, before I let you go, I do want to ask you about something that might seem like common sense, especially when we're talking about a regulated industry such as financial services. But why is it important that artificial intelligence actually explains its stock picks?
Transparency is hugely important when using tools like this. Now, I don't want to be too simplistic or unfair, but when you're challenging or asking a question of a generative AI like ChatGPT, truly understanding how it comes up with that answer, it does maybe not have too many kind of pitfalls to it. But if you're trading off something, if you're putting client money at risk, then we need to truly understand where the positioning comes from. So in the way that we train our models, the techniques that we choose to use, they're very much focused on interpretability and transparency. My portfolio managers who trained and developed this strategy and then deploy it, they have tools that allow them to understand the reasoning behind the AI in every position that it takes within our portfolios and how it drives the positive active return.
Well, David, it was great talking to you. Thank you so much for joining me, and thank you so much for sharing all of your insights as well as your perspective.